Welcome back to Bodhi Unified Flow. Here we do two things. We simplify complexity and we amplify your performance. Today, we're diving straight into a masterclass on a question that haunts almost every investor. Exactly when do you buy and when do you actually hold on to your mutual funds? This explainer focuses specifically on part 4 of our comprehensive series, The Buy, Hold, and Sell Blueprint, Equity, MFs, REITs, and Gold ETFs. Look, if you've ever felt like you're just kind of guessing when it comes to deploying your hard-earned capital into the markets, stick around. This is absolutely going to change how you operate.
So, just so we're all on the same page, here's our rapid-fire roadmap for today. We're going to completely deconstruct the old buy and hold mindset, establish some incredibly precise tactical buying triggers, and lay out the exact quantitative standards a fund needs to meet to stay in your portfolio. Then we'll wrap it all up with how to properly rebalance.
All right, before we get deep into the math and the algorithms, let's get crystal clear on what you're actually taking away from this. By the end of this explainer, you're going to have a concrete, data-backed framework to manage your mutual funds. We're literally throwing the guesswork out the window. You'll understand the dynamic hold mindset, you'll know exactly how to use the 200-day simple moving average as your tactical buy trigger, and you'll have strict quantitative standards to ruthlessly review your portfolio every 3 to 5 years.
Okay, let's jump into our first major concept. We really need to talk about evolving beyond the whole buy and forget myth. You might be familiar with Sandeep Tandon over at Quant Mutual Fund. Well, he recently dropped this massive truth bomb. He said, and I quote, "That era of buy and hold is over. You have to review your portfolio every 3 years, every 5 years, otherwise the non-performers become your core portfolio." Think about that for a second. This is a total paradigm shift. Blindly holding on to a failing fund? That isn't patience, my friends. That's just a fast track to wealth destruction.
It's literally night and day when you compare the two. The traditional buy and forget approach, it's like dropping a heavy anchor. It's static, it's driven entirely by emotion, and it lets the losers linger and drag down your overall returns. What we want is the dynamic approach on the right, agile, data-driven. It's a systematic pruning process. To create real wealth, you have to ensure your capital isn't trapped in assets that are quietly deteriorating behind the scenes.
So, that brings us to the million-dollar question. When exactly do we pull the trigger and buy? Let's get into the tactical strategy.
To do this right, we have to completely remove human emotion, and we do that by using the 200-day simple moving average, or the SMA. If you aren't familiar, this is the gold standard institutional trend filter. It just calculates the average closing price over the last 200 days. Actually, scratch that. It's more than just a filter. It's your objective truth. It tells you, without any bias, whether the market is in a structural uptrend or a structural downtrend. It cuts right through all that daily headline noise.
The way you use it is beautifully simple. It's just a 3-step decision tree. Step 1, you check the daily close of your target sector or index against its 200-day SMA. Step 2, if the index is trading above that average line, boom, that's your green light. You allocate capital and capture that momentum. But step 3, the moment it drops below that SMA, it means the structural trend is broken. No second guessing, you liquidate and reallocate to safety, like cash or liquid debt funds. It is a strictly unemotional, rule-based execution.
And hey, you don't have to just take my word for it. The historical data backs this up entirely. Look at the S&P 500 over a massive 20-year stretch from 2000 to 2020. A blind, traditional buy and hold strategy gave you a Sharpe ratio of 0.42. But if you apply this exact 200-day SMA rule, that risk-adjusted return jumps to 0.64. Why? Because by sidestepping those massive bear market crashes, you drastically improve your long-term results. In investing, you win big by simply choosing not to lose big.
Right, so you've used the trigger and you've bought the fund. The next step is knowing exactly what it takes for that fund to earn the right to stay in your portfolio.
This is where we get ruthless. These are the absolute non-negotiable mathematical standards you need to demand from any active mutual fund. First up, the rolling return beat rate. It has to be above 65% over a 5-year window. This metric is brilliant because it explicitly separates real, consistent managerial skill from just random market luck. Then you want an information ratio greater than 0.5 to prove they're actually generating risk-adjusted excess returns. And finally, the big one, a Sortino ratio greater than 1.0.
I want to double-click on that last metric for a second, because downside protection is absolutely paramount. Having a Sortino ratio above 1.0 is the mathematical proof that your fund manager isn't just asleep at the wheel. They are actively shielding your capital when the market takes a hit. Listen, anyone can look like a genius surfing a massive bull market. True managerial skill is revealed when things go south and your wealth stays protected.
Now, let's move into the discipline of maintenance. This is honestly the most overlooked, underappreciated phase of the entire blueprint.
Sridhara Valdar from Canara Rebecca Mutual Fund perfectly summarizes the mindset we need here. He says, discipline itself is going to create more returns than actually jumping the styles or actually keep thinking more about the styles. The takeaway? Yes, we actively review our portfolios to ditch the losers, but we also need the ironclad discipline to stick with our mathematically sound strategy. No chasing fads, no jumping ship just because a new trend pops up on social media.
To put that discipline into practice, here is your operational timeline. Year 1. That's your initial deployment, using the 200-day SMA tactical buy we talked about. Year 3. This is your first mandatory check-in. You pull up the data, you check those rolling returns, you check those Sortino ratios. And then year 5, this is the critical rebalancing phase, where you ruthlessly weed out the chronic underperformers. Following this exact cycle keeps your capital highly efficient without triggering a bunch of unnecessary taxes or exit loads.
Okay, we've covered a ton of ground today. Let's consolidate everything you've learned and bring it all together.
We set out to build a blueprint, and here it is. We've officially shifted from that dangerous buy-and-forget trap into a powerful, dynamic hold mindset. You now know how to execute tactical buys with the 200-day SMA to protect yourself from major drawdowns. You've got your strict holding standards, never settle for less than a 65% beat rate, and you've got your systematic 3 to 5 year review cycle. You are now equipped with a completely unbiased institutional-grade framework.
As always, transparency is key here at Bodhi Unified Flow. The insights from today's explainer were drawn directly from our Buy, Hold, and Sell Blueprint research document, along with some incredibly valuable expert interviews from Zeroda's Varsity's Know Your Fund Manager series featuring Sandeep Tandon, Sridhara Brandewalder, and Vinit Sambre.
So, I'm going to leave you with one final, hard-hitting question. Take a real, honest look at your portfolio today. Is it currently bogged down with legacy non-performers that are just quietly draining your potential wealth? Or are you ready to dynamically apply this 200-day SMA blueprint starting right now? Ask yourself, are you truly managing your wealth, or are you just kind of hoping for the best? The tools are now in your hands. It's time to put them to work.